I spent 9 years inside the system. Equity desk, macro research. The kind of job where you learn to speak in basis points and forward guidance. And in that world, there was an unspoken rule, a catechism really, that gold was finished. A relic. Something your grandfather buried in the yard because he didn't understand ETFs. I believed it. I believed it the way you believe gravity. Not because I'd tested it, but because everyone around me treated it as settled science. Paper currencies had won. Central banks had won. The future was digital, liquid, and managed by people with PhDs. Gold was for doomsday preppers and history teachers. Then I started looking at the history teachers' data. It began with a simple chart. Not a trading chart, a civilizational one. 5,000 years of monetary systems plotted on a timeline. Sumer, Egypt, Athens, Rome, Tang Dynasty China, the Abbasid Caliphate, Byzantine Empire, Renaissance Florence, Habsburg Spain, the British Empire, the American century. Every single one of these systems, every one used gold as a monetary anchor at some point, and every single one that abandoned it eventually came back or collapsed trying to replace it. That pattern should not exist. If gold were truly a relic, history would show a clean break, a moment where humanity outgrew it and never looked back. That moment does not appear in the record. What appears instead is a cycle, a loop so consistent it looks engineered. I pulled the Sumerian records first. Around 2600 BCE, the shekel wasn't a coin. It was a weight of silver and gold used to settle debts in temple economies. When those economies destabilized, when grain reserves failed, and trust between city-states fractured, the system didn't reach for innovation. It reached for metal. For weight, you could verify with a scale and nothing else. 3,000 years later, Rome ran the same experiment at imperial scale. The aureus, 7.9 grams of gold, struck with the emperor's face, functioned as the bedrock of a monetary system that financed legions, aqueducts, and the longest peace in European history. It worked until it didn't. Until the empire needed more money than it had gold. We'll get to what happened next, but here's what stopped me cold. The failure mode was identical. The same sequence, the same desperate logic. Separated by 30 centuries, two civilizations hit the same wall and made the same choices. I checked 6 more civilizations, then 10, then every major monetary system I could source. The pattern didn't break, it didn't vary, it didn't evolve. That's when I stopped believing gold was a relic. Not because I became a gold bug, not because I read some manifesto, because the data, my own data, pulled from primary sources, told me something I wasn't trained to hear. Gold never came back because people loved it. Gold never came back because of tradition, or sentiment, or superstition. Gold came back because everything else failed first. And that failure follows a script. The script is always the same. I've read it in Latin, in Mandarin, in Ottoman Turkish, in the desperate memos of French revolutionaries. The language changes. The mechanism never does. Step 1. A state needs more money than it has. War, famine, ambition. The reason doesn't matter. What matters is the gap between what a government wants to spend and what it actually holds. Step 2. Instead of closing the gap with taxation or restraint, the state closes it with manipulation. It dilutes the currency. Step 3. People notice, trust fractures. And step 4. The final step, the one that has never once failed to arrive, gold reprices to tell the truth that the currency no longer can. Rome is the cleanest case study because the data survived. In 64 AD, Nero reduced the silver content of the denarius by roughly 10%, a modest shave, barely noticeable. By the time Diocletian took power 2 centuries later, the denarius contained less than 5% of its original silver. The coin still circulated. It still had the emperor's face on it. But the economy beneath it had already made its judgment. Prices didn't just rise, they detonated. Diocletian's own edict on maximum prices, issued in 301 AD, listed over 1,000 goods with fixed ceilings. It failed within years. You cannot legislate trust back into a currency you've already hollowed out. Gold and barter replaced the imperial monetary system not because Romans wanted them to, but because the denarius had become a fiction. China discovered the same truth independently. The Song dynasty introduced jiaozi, the world's first government-issued paper money, around 1024 AD. It was brilliant, portable, scalable, modern. It was also irresistible. Within a century, the government printed far beyond its reserves. Inflation became uncontrollable. The Yuan dynasty repeated the experiment. Same result. The Ming dynasty repeated it again. Same result. Each time, the collapse ended the same way. A return to silver and gold as the only credible settlement instruments. 3 dynasties, 3 centuries. One lesson learned and immediately forgotten. Spain's version was different in origin, but identical in outcome. When silver flooded in from Potosi and the New World, the crown didn't debase its coins. The supply itself did the debasing. Prices across Europe quadrupled in a century. The price revolution proved something even more unsettling. You don't need a corrupt government to destroy monetary trust. You just need too much money chasing the same goods. Gold's relative scarcity held its purchasing power while silver-heavy systems buckled. The French assignat, the continental dollar, the Weimar papier mark. I tracked 17 currency collapses across 3,000 years, and every single one followed the same 4 steps. Expand, dilute, deny, collapse. And in every aftermath, every single one, gold re-emerged as the monetary standard. Not by decree, not by ideology, by exhaustion. Societies didn't choose gold because they believed in it. They chose gold because they had stopped believing in everything else. The mechanism, and we are not exempt. August 15th, 1971, a Sunday evening. Richard Nixon looked into a camera and told the world that the United States would temporarily suspend the convertibility of the dollar into gold. Temporarily. That word should haunt you, because 54 years later, the suspension has never been lifted. The last tether between the world's reserve currency and physical gold was severed in a televised address that lasted less than 20 minutes, and everything that followed, everything, fits the script. I remember the moment I overlaid the charts. I had the Roman debasement curve on one monitor and the US dollar's purchasing power since 1971 on the other. I didn't need to run a regression. I didn't need a model. The shapes were nearly identical. A long, slow, downward bend. Not a crash, a drain. Since Nixon closed the gold window, the dollar has lost over 98% of its purchasing power measured against gold. The British pound has done worse. The Japanese yen has done worse. The Turkish lira, the Argentine peso, the Nigerian naira, every fiat currency on earth, without a single exception, has depreciated against gold since the last anchor was removed. Every one. I checked. I kept checking, hoping to find the outlier. The outlier does not exist. And the pattern accelerates at the moments you'd expect. After the 2008 financial crisis, gold moved from around $700 an ounce to over $1,900 in 3 years. The system cracked, central banks flooded the world with liquidity, and gold repriced. After 2020, the same sequence compressed into months. Pandemic, shutdown. The largest monetary expansion in human history, over $5 trillion created in the United States alone. Gold broke its all-time high, again. But here's what keeps me awake. Every intervention that drove those gold spikes was described as temporary, emergency, extraordinary. Quantitative easing was supposed to be unwound. Zero interest rates were supposed to normalize. Balance sheets were supposed to shrink. None of it fully reversed. The Federal Reserve's balance sheet went from $900 billion in 2008 to nearly $9 trillion by 2022. The Bank of Japan now holds assets exceeding its country's entire GDP. The European Central Bank owns a quarter of all Eurozone government debt. These are not policies. These are dependencies. And every dependency follows the same thermodynamic law. It requires escalating doses to produce diminishing effects. I used to think I was studying history. I was mapping ancient empires and their monetary collapses like an archaeologist brushing dust off bones. Detached. Academic. Then I looked up from the data and realized I wasn't observing the pattern from outside. I was sitting inside it. We all are. The dollar is not the denarius. I'm not making that naive comparison. The global economy is more complex, more interconnected, more resilient in certain ways. But the mechanism doesn't care about complexity. It cares about one variable: whether a currency is being expanded faster than the economy it represents. And by that measure, the only measure that has mattered for 5,000 years, we are running the script. The only question left is which step we're on. I think we already know. In 2022, central banks bought more gold than in any year since 1967. In 2023, they did it again. In 2024, they accelerated. China, Poland, India, Turkey, Singapore, Kazakhstan. Not retail investors, not hedge funds. Central banks, the very institutions that manage fiat currencies, were quietly, steadily converting reserves into the one asset they told the rest of us was obsolete. I spent a week sitting with that data, not analyzing it, just sitting with it. Because when the people who print the money start hoarding the thing that money was supposed to replace, the cognitive dissonance becomes physically uncomfortable. And it isn't just buying, it's architecture. The BRICS nations have spent 3 years building settlement frameworks that reduce dollar dependency. Saudi Arabia has priced oil outside the dollar for the first time in half a century. China's central bank has tripled its reported gold reserves since 2009. And those are the reported numbers. The international monetary system is not collapsing. It is being quietly restructured. And at the foundation of every alternative blueprint I've reviewed, sitting there like a geological constant, is gold. I want to be clear about what I'm not saying. I'm not saying the dollar will die tomorrow. I'm not saying you should sell everything and buy bullion. I am not a financial advisor, and this is not a prediction. What I am saying is that I spent 3 years tracing a pattern across 5 millennia, across every continent, across civilizations that never had contact with each other. And the pattern is undefeated, not mostly consistent, not generally reliable, undefeated. Every fiat experiment ends, every currency debasement resolves, and every resolution, without exception, involves gold, reclaiming a monetary role that the previous generation swore it had lost forever. I think we misunderstand what gold is. We price it in dollars and treat it as an asset class, a commodity, a trade, a position in a portfolio. But gold doesn't behave like a commodity. Commodities get consumed. Gold accumulates. Nearly every ounce ever mined in human history still exists. It doesn't corrode. It doesn't decay. It just waits. And what it measures is not price. What gold measures is trust. When trust in institutions is high, gold sits quietly. When trust fractures, gold reprices, not because it has changed, but because everything around it has. 5,000 years. Sumer to the Federal Reserve, clay tablets to blockchain. The technology's transformed completely. The money changed form 100 times, and gold is still here. Not because anyone decided it should be, because nothing has ever successfully replaced it for more than a few generations. So I'll leave you with the only question that matters, not what gold will do next quarter, not where the price target sits. Forget the price. The question is simpler and far older than any market. In 5,000 years of human civilization, every paper currency ever created has eventually failed. Gold has not. Do you really believe this time is different? I don't.